Hi, my name is James, and today we're taking you through Japan's interest on excess reserves problem. I'll summarize this equation that summarizes Japan's terrible situation, yeah? Okay, first, what is the interest on excess reserves? How do we get here? So in the fallout 2008, around 2.9 trillion was printed up to buy 1.7 trillion US treasuries and 1.2 trillion mortgage-backed securities. And this allowed basically the financial system to prevent collapse and continue on working. But the consequence was the interest rates were always stuck at zero because the banking system was full of reserves. So basically, if I went to the bank, wanted a short-term loan, I could get one very easy because they have so much cash, they just want to give it out. And this drives speculation and can cause big problems. So the central bank needs a tool to raise interest rates because the problem is the demand for cash is zero because everyone has cash, and everyone offering cash will offer it at zero rate. So the new tool needs to be invented. That's how the interest on excess reserves is created. So basically, the central bank will come along and offer a bank or all these banks on their reserves interest 5.5%. So instead of lending out to me at 0.3, they can lend out to the central bank or the Federal Reserve at 5.5%. And this pushes up my interest rate because now no one's going to lend to me a high risk investment when they can lend to the central bank at 5.5%. They're going to charge me a little premium as well. So this is how they raise interest rates now. And they lower it 1.5%. So there's 1.5% paid on all these reserves, so they don't lend out to me. And this brings down my rate, but it brings up asset prices. Yeah, basically, as you raise interest rates, asset prices come down, and as you lower interest rates, asset price comes up. And what you can see here is just the basic formula for interest on excess reserves in the system times the interest rate. So all these reserves added together on here times the interest rate, which is 1.5%. It's $48 billion. Yeah, and the central bank has to pay this every single year to keep interest rates at 1.5%. They want to raise interest rates higher, this cost goes up, and if the reserves in the system go up, this cost goes up too. So this brings me to Japan's situation. So the change in reserves equals QE, quantitative easing, minus quantitative tightening, plus reserves times the interest on excess reserves, the rate, minus the central bank balance sheet average rate. So whatever the average yield is on the entire balance sheet, that's that rate, yeah? So QE for last year for Japan was 0, and total passive QT was around 60 trillion, yeah? And the interest on excess reserves currently is at 0.5%, and the central bank balance sheet average income or average yield on the debt on the entire balance sheet is 0.5%. And total reserves in the system currently now is about 580 trillion yen. So you put this into the formula. So we got 60 or negative 60 in quantitative tightening, and we got 580 trillion in reserves, and 0.5 interest on excess reserve minus 0.45 average reserves on the central bank balance sheet, yeah? And what this comes out to is negative 31 trillion yen leaving the system, which is a good thing. When you're doing quantitative tightening or raising interest rates, you want deflation. You don't want the number of reserves to be increasing because this can cause a massive problem. And this is what I lead, the limits of quantitative tightening. So the longer the balance sheet duration, the slower the roll-off. If you think about it this way, if it's a 10-year duration, the average bond on the balance sheet, it'll be very slow. It'll take 10 or so years to roll off. But if it's 2 years, it will come off very quick, and the balance sheet will reduce fast. As you can see here, with the balance sheet of Australia, but the average duration bond is 6.5 years. So you can see the roll-off is really quick, whereas the roll-off is very slow because it's 10 years on the Japanese central bank balance sheet. Bank of Japan. Okay, so let's look at this, the inelasticity of interest on excess reserves, or interest income. So let's just say the interest on excess reserves was increased from 0.5% to 12%, just hypothetically. Can the Bank of Japan actually do this without causing inflation in reserves? So the Bank of Japan's rollover is about 10 years. So the problem is, for the central bank's average interest rate to roll over to 12%, it would take decades, yeah? A very long time for this balance sheet to get its average interest rate up to 12%. And the problem is, it's very inelastic. It takes a very, very long time to adjust. Whereas if you change this, the interest on excess reserves, the price or costs change immediately. And the difference here is how much money needs to be printed to fund this, yeah? And so QE is 0 and quantitative tightening is still 60. But the problem is now we have interest and excess reserves at 12, and the central bank average interest rate on the balance sheet is 0.45. The reserves haven't changed. So if we put these into the formula, we can see that this interest rate here is enormous, and this makes this thing enormous, and it cancels out the passive quantitative tightening that's going on. And this will require, otherwise it's inflationary. You think about this, right? So if this is inflationary, it increases the reserves, and this increases this reserve balance here, which then increases this, which then increases this, which is basically a feedback loop, yeah? So you need to conduct quantitative tightening, or hard QT. And what this means is, they do hard QT, they'll be selling off this at a faster rate, or dumping bonds, or what this do is spike long-term interest rates. And this can be a very bad feedback loop. So what I want to summarize on is, as the reserves, or this balance sheet, continues to expand, this side of the equation becomes more important. And this differential, as we've seen, the inelasticity of the central bank balance sheet's interest income, or the interest income, is very slow to adjust to a massive spike in interest rates. Even if we slowly rise it, the difference, or basically the differential becomes bigger and bigger, yeah? Because this is very quick to adjust. It goes instantly to the target, and the costs add up difference. But this takes a while. So eventually, as the reserves get bigger and bigger, you can never raise interest rates, yeah? Your interest rates get stuck at 0, wherever they were, and these two will need to cancel each other out, because if you ever do raise interest rates, these two will times each other, and then this will override your quantitative tightening or enhance your QE and lead to the end of Japan.